Gold is approaching a massive liquidity zone where smart money is preparing the next major displacement. My primary focus right now is a potential sell setup targeting huge liquidity pools below, but there's one critical condition that absolutely must happen first. The reality, most retail traders are looking at the exact wrong level today. Let me show you where institutions are actually targeting. So, straight to the point, my bias on gold is strictly bearish. We are targeting the massive sell-side liquidity resting right below the 39.60 level. That is the primary draw on liquidity today. But here is the problem. We can't just sell right now. We have to wait for a very specific pullback first. Before we break down the charts, here is the exact institutional action plan for this session. We are staying bearish, and our primary setup is to sell off a 15-minute premium fair value gap. That means we're waiting for a key entry between 40.46 and 40.52. The expected external liquidity target sits down between 39.70 and 39.60. You know the setup. Now, let's look at why smart money is targeting this exact zone. This bearish order flow isn't just technical, it's heavily fueled by macro drivers. We're seeing escalating geopolitical tensions, specifically new tariff policies and ongoing Red Sea disruptions, which are pushing WTI crude oil above $90 a barrel. When energy costs spike like that, it revives hawkish expectations for the Fed. Because of this renewed inflation threat, the US dollar index is holding firmly near 101.50. A hawkish Fed and a strong dollar create immense downside pressure on gold, and institutions are aggressively pricing this in. Looking at the daily time frame, the macro draw on liquidity is undeniable. After a major distribution phase up at the premium peak, the market shifted into a heavy markdown phase. What happens next? The algorithms seek out the closest, largest pockets of resting orders to balance the books. Right now, that's the massive sell-side liquidity pool sitting right below those recent lows, specifically between 39.70 and 39.50. Dropping into the 4-hour chart, we've got a confirmed market structure shift. We saw this incredibly strong bearish displacement expanding right off the 41.63 swing high. Now notice what that aggressive move left behind, a massive open fair value gap. In smart money concepts, that gap is the literal footprint of institutional sellers. It proves they control the order flow, and it establishes a heavily defended premium zone that we can leverage. But here's the catch. We don't have institutional confirmation to enter right this second. Price is currently sitting in a deep discount array, which means executing a sell here is basically gambling. To get involved, you have to be patient. We need price to retrace higher into that premium fair value gap, specifically between 40.46 and 40.52, and we need to see a confirmed 15-minute market structure shift before pulling the trigger. Without that shift, you're just guessing. When we zoom into the 15-minute chart, we can clearly see the optimal trade entry zone. This 40.46 to 40.52 imbalance is exactly where smart money is waiting to reload their short positions. By waiting for price to return to this specific premium level, we align ourselves perfectly with institutional order flow. We only step in when the market offers a premium price, rather than just blindly selling when downside momentum feels heavy. So if that 15-minute structural shift triggers inside our premium zone, here is your executable trade plan. You'll look for an entry right inside that 40.46 to 40.52 imbalance. Your stop loss needs to be strictly placed just above the invalidation level at 40.61.50. For targets, we take our first partial profit at the recent session low of 40.26 to kill the risk. Then, we scale out again at the 39.95 psychological level, leaving a runner for that ultimate 39.60 target. If we don't get that confirmation shift, no trade. It's that simple. Now, this is exactly where most retail traders are going to get trapped today. They look at the chart, see that heavy downward momentum, panic, and end up chasing the price. They're selling at the absolute extreme discount low around 40.26. But institutions, they aren't selling there. Smart money is just waiting to engineer a pullback, rebalance that premium fair value gap at 40.46, and then launch the true next leg down. If you're chasing discount prices, you are just becoming liquidity for someone else's premium entry. And the market is actually sending us a warning signal regarding today's macro data. We have high-impact US Flash PMIs and new home sales coming out, and you can expect these events to be weaponized by algorithms. It's highly likely we'll see an aggressive upward sweep of internal buy-side liquidity, taking out the Asian and London session highs just to trap early short sellers, before finally expanding lower into our 39.60 target. Let's do a quick recap of the plan. Maintain a strict bearish bias, but wait for that 40.46 pullback and confirmation. If it doesn't appear, you stay out.
Manage your risk tightly, strictly between 0.5 and 1% per position. And keep in mind, this entire bearish narrative is completely invalidated if we get a 1-hour candle closing above our 40.75 level. Discipline is the only currency that matters here.
If you appreciate institutional-style market analysis using smart money concepts, consider subscribing to ICT Market Theory for more explainers like this. And if you'd like to trade alongside these exact setups, you can find the FXTM account link in the pinned comment below. So, when the algorithms trigger today's data release, will you be the one trapped at the bottom or the one waiting patiently at the premium?